Hi everyone, welcome to another episode of the Patient Owner channel. Last week, the Fed cut rates. In this episode, we are going to see how markets react to this historically, how the market reacted last week, and what I'm currently doing. Before we start, like this video and subscribe to the channel to help us grow. As a reminder, these videos are for educational purpose only, and make sure you do your own research before taking any financial decisions. Okay, let's jump straight into the video. If you are following the markets, you should know that the Fed cut rates by 25 basis points last week, which marks a new interest rate cut cycle. Let's go onto the Fed website and just go through their press release. Recent indicators suggest that growth of economic activity moderated in the first half of the year. Job gains have slowed, and the unemployment rate has edged up but remains low. Inflation has moved up and remains somewhat elevated. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. Uncertainty about the economic outlook remains elevated. The committee is attentive to the risks to both sides of its dual mandate and judges that downside risks to employment have risen. In support of its goals and in light of the shift in the balance of risks, that is, unemployment now is more important than inflation, the committee decided to lower the target range of the federal funds rate by a 0.25 percentage point, and the committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. Zooming out and looking at the 30-year federal funds effective rate chart, we can see that the latest rate rises were very aggressive and something we haven't seen in recent history. Within 1.5 years, we went from 0 to 5.3%. This hasn't happened before in the last 30 years. The closest we got was back in 2004, where rates increased within 2 years from 1% to 5.25%. So last time we had rates rising faster and further. Okay, now let's look at their Fed dot plot. The important piece here is to compare it with the most recent meeting. So let's put them side by side. On the left, we have the September release, and on the right, we have the June release. And it's clear that the dots have come down over the two reports, which means the Fed fund rates are expected to come down over the next 2 to 3 years. The majority now expect the Fed fund rates by the end of the year to be somewhere around 3.5 to 3.75%, whereas in June, expected to be around 3.75% to 4%, so it came down. Looking at 2026 and 2027, we can see a similar trend with Fed fund rates coming down over time and more people expecting lower rates over the next 2 years. Now, with that being said, the Fed controls the short end of the yield curve. What's the yield curve? Essentially, is the return that investors require when investing in government bonds. As demonstrated on this chart, short term is linked to the Fed fund rate, and the long term is very different as investors have their own views on what returns they expect. Now, going from the 17th of September to the 18th, you will see that the short-end yield term went from 4.5 to 4.25, reflecting the 25 basis point reduction from the Fed fund rates. We can also see that longer-term yields did not change, which means investors already priced in all of that. Now, what impacts longer-term yields? And this is important because longer-term yields affect the market. There are two key factors. Inflation expectations. Higher long-term inflation expectations cause long-term yields to rise. This is because inflation erodes the purchasing power of a bond's fixed interest payments. And to compensate for this, investors demand a higher yield to achieve a positive real inflation-adjusted return. The other key factor is the market's expectations for future economic growth. When a strong economic expansion is anticipated, investors expect higher inflation and believe that central banks will raise interest rates over time. This makes holding long-term bonds less attractive, so as a result, investors demand higher yields to compensate, leading to a steeper yield curve. Okay, now you know what the Fed did and how the yield curve is impacted. What does all of this mean for investors and the stock market? The market is at all-time highs. The Fed is cutting rates. The fear and greed index shows that we are at a period of greed. We have the S&P 500 price to earnings multiple sitting at around 29.5 times, which is historically above average. We have indicators that are flashing a recession might be coming. This chart here shows the heavyweight truck sales with the S&P 500. We have the US heavyweight truck sales coming down. And in the past, when these sales come down, we had bear markets. We can see this in 2020 during the pandemic. The reduction in sales around 2016 didn't materialize to a bear market, but the same happened back in the financial crisis of 07-09. and during the dot-com bubble in 2001. We are in this new environment. In my opinion, volatility is coming back. So let's see how the market reacted last week. And as we can see from this chart here, it's a mixed bag. We had tech doing absolutely fine, semiconductors with the exception of Intel due to the Nvidia partnership being down to flat. We had the banks doing absolutely fine. We have the financial data and stock exchanges not doing great. We have home improvements down, auto parts down, discount stores down, as expected, REITs down, and generally speaking, it's a mixed bag. Given this new environment, expect volatility, and what I'm doing is I am getting ready to capitalize on this volatility. I am constantly researching companies and created this early screen watch list on Trading 212, where I keep companies that meet certain criteria. You'll see it includes companies like Moody's, S&P Global, Intuit, Meta, Alphabet, Amazon, LVMH, Evolution, Grab, Duolingo, Nibius, Hermes, KinselCapitalBooking.com, and I am sure many more companies will be added on this, but also removed as I do additional research and determine if these companies are good for my portfolio or not. That being said, bear markets are inevitable. This chart shows the S&P 500 price index since 1956. Bear markets with recessions are the shaded parts. Bear markets are 20% declines in price from prior peaks, and bull markets begin at each market bottom. The chart shows that bear markets are unavoidable, bull markets are much longer with larger returns. Since 1956, the average bear market has lasted 1 year and 2 months with a decline of 36%. In contrast, the average bull market lasts 5 years and 9 months and returns 192%. This is not fear-mongering, I'm just saying that bear markets are inevitable and will happen at some point in time. Zooming out, it is clear that it's better to remain invested as bull market returns are much higher than bear markets, and as I discussed many times in the past, it's very difficult to time the market. I'm definitely going to be transparent on this channel. I'm not planning to divest, so make sure you subscribe to see how this portfolio does. I'll show you the good and the bad performances over time. Personally, what I'm doing, I am essentially getting ready to capitalize on this increased volatility. I focus on hard data, i.e. what has happened in the last times that the Fed cut rates and what is the best course of action for myself. So looking at the question of what happens when the Fed cut rates, we have this report here from the Scottish Widows. In the 12 months after the US Federal Reserve, the Fed, starts cutting interest rates, the average return from US stocks has been 11% ahead of inflation. Stocks have also outperformed government bonds by 6% and corporate bonds by 5% on average. These outcomes are the findings of new long-term analysis of investment returns during 22 US interest rate cutting cycles since 1928. And looking at this table, the majority of times US stock market is positive following Fed cut rates in the next 12 months, and on average with a recession, the stock market returned 8% in real returns, and without the recession, the stock market returned 17%, outperforming government bonds, corporate bonds, and cash. Recessions or not, following Fed rate cuts, the US stock market returned better results compared to government bonds and cash. Looking at another report from Vanguard around trying to time the market, why ignoring market dips can double your wealth. Discover how staying invested through market downturns can boost your wealth. Learn about the power of compounding and the risks of market timing. The importance of being disciplined isn't just a belief or idea, it's backed by solid data. Recently, Vanguard conducted a study to quantify the benefits of staying invested through all the major market downturns since 1975, compared with exiting the market each time and buying back in 6 months later. We found that someone who stayed invested would have nearly double the wealth today. So let's look at the numbers. They analyzed how much an investor could have today if they invested £100 in global shares at the start of 1975. This long investing time frame also lets us see the impact of several different bear markets, defined as a fall of more than 20% from the market's most recent high. There have been 7 bear markets in global shares since 1975, including the bursting of the dot-com bubble, the global financial crisis in 07-09, and the COVID-19 pandemic in 2020. The results are clear. If the investor stayed invested through all these bear markets, then £100 would have grown to £29,307 today. However, if they exited the market every time it dropped by 20% or more and then bought back into the market 6 months later, each time they would have only £15,663. So staying invested through these bear markets means you'd be doubling your money compared to someone that exited the market after the 20% drop and re-entering after 6 months. So given last week's Fed rate cut, we are entering a new environment. I expect volatility to pick up. We know that bear markets are inevitable, but the best course of action is remain invested as this report shows, and US equities outperform other asset classes 12 months after a rate cut. And this is exactly what I am personally planning to do. So, looking at my portfolio, we reached a new milestone as we surpassed the £10,000 in investment value. The total return is £1,154 or 12.5%. And as you can see from my allocation, I added S&P Global in my portfolio, capitalizing on the volatility. Current allocation is 38% in Google, 26% in Amazon, 14% in S&P Global, 10% in Fair Isaac, and the remaining in Adobe. As I mentioned earlier, my plan is to capitalize on this volatility. Last week, S&P Global stock fell by 6 to 7%, so I decided to pick up 4 shares of the stock. S&P Global provides credit ratings, benchmarks, analytics, and workflow solutions in the global capital, commodity, and automotive markets. Market cap is $155 billion. The trailing P is sitting at 39. 3-year revenue CAGR is 15%. 3-year EPS CAGR is a negative 1%. Forward P sits at 28 times. There is a net debt balance of $10 billion and the company pays a small dividend. A quick overview of how management thinks of the various divisions of the business. S&P Global Ratings, our analyst-driven credit ratings, research, and sustainable finance provide critical insights that are essential to translating complexity into clarity so market participants can uncover opportunities and make decisions with conviction. S&P Dow Jones Indices, we provide iconic and innovative index solutions backed by unparalleled expertise across the asset class spectrum. By bringing transparency to the global capital markets, we empower investors everywhere to make decisions with conviction. Especially if you are invested in S&P 500 ETF, S&P Global is benefiting from a fee. S&P Global Commodity Insights, with our unparalleled data and deep insights of global energy and commodity markets, we enable our customers to make decisions with conviction and create long-term sustainable value. Market Intelligence, our team of experts deliver leading data and technology solutions, partnering with customers to provide them with unrivaled insights to expand their perspectives, operate with confidence, and make decisions with conviction. And S&P Global Mobility, which by the way management is going through this spin-off of this section, we provide invaluable insights derived from unmatched automotive data, enabling our customers to anticipate change and make decisions with conviction. We help to optimize their businesses, reach the right consumers, and shape the future of mobility. I'll do a different deep dive video for S&P Global. These are the divisions. Let's look at their revenue. We have Market Intelligence revenue, Ratings revenue, Commodity Insights, Mobility revenue, and Indices. And as we can see over time, all of these business segments are growing. The company doesn't shy away from acquisitions or mergers, with one of the bigger ones they completed in recent history is the merger with IHS Markit, creating a global leader to power the markets of the future. This is clearly reflected in the number of shares, as we can see this spike in 2022, but since then the company continued purchasing back shares. In my opinion, S&P Global is a compounder. I expect revenue, earnings, and free cash flow to continue to grow in the medium to long term. And currently trades at the fair value. The forward PE is sitting at 27.9 times, and the forward free cash flow yield sits at 3.95%. The company is a high margin business and has a good moat. Looking at the Morningstar report, let's go through some of the details. Credit ratings provide value to bond issuers, such as corporate issuers, as well as bond investors, creating a network effect. Bond issuers value credit ratings from Moody's and S&P because of their wide acceptance amongst asset owners and asset managers. This is particularly important in cross-border bond issuance deals. While a local country's domestic rating agency could have value for its domestic bonds, a rating from Big Three firm is critical for a cross-border market security, as global investors desire broad comparability across global bonds. Most importantly, in my opinion, this broad acceptance makes it essential for corporate issuers to get a rating of any debt they issue. By getting a bond rating from a market leader such as S&P, the bond issuer pays less in interest, often 30 to 65 basis points in savings per year. In other words, if you get a credit rating from S&P Global, you are saving money. S&P has been able to leverage its moat to obtain solid pricing power, typically around 3 to 4% per year. S&P Dow Jones Indexes has built a strong moat with its flagship benchmark, the S&P 500 Index. S&P monetizes its indexes in primarily three ways: index subscriptions, asset-linked fees, and transaction royalties on exchange-traded futures and options. Once an index becomes dominant in a certain segment and has widespread acceptance among stakeholders, it tends to stay that way. An asset manager may prefer to be indexed against the Russell 1000, but if asset owners and consultants prefer the S&P 500, the asset manager will risk outflows, so they stick with the S&P 500. The commodity insights segment, that essentially is an index business for certain commodities, is similar to how the S&P 500 dominates US large cap equities and MSCI dominates international equities. Typically, one benchmark dominates a certain commodity, and moreover, Platts prices are used in long-term contracts, thus guaranteeing the use of its prices for a certain period. Commodity switching by market participants tend to be rare and is not usually driven by pricing. On mobility, I'm not going to spend time here. It's still a great business, but management announced that they plan to spin off the business into a separate public company. Lastly, on market intelligence, this is a narrow mode business based on switching costs. By being embedded in customer flows, customers face switching costs due to the hassle involved. I'll leave it here. Let me know in the comments below if you would like to see an S&P Global deep dive video. Subscribe to the channel and I'll see you in the next one.